Are you starting to invest in stock and really want to know what the tax implications are? I want to make sure that you understand what it feels like, looks like to make money with stock and how to reduce your tax bill. That is why in this video, I am going to break it all down for you and even give you a #1 strategy that the rich people use when it comes to stock. But before we jump in, I'm gonna need you to like, comment, and subscribe so you don't miss out on any wealth building information. Now, let's get after it. Investing in stock is such a great move. Whether the stock market goes up or goes down, the fact that you're in the market is a big deal. But it's so important for you to understand the tax implications of being invested in stock. One of the things that is super important is to realize that when you sell stock, that all the time you're going to end up with documentation that is going to be needed to be reported on your taxes at the end of the year. Many of you may think, Carla, I didn't make any money. I sold that stock. I didn't take a dime out of that account and I didn't make any profit. It doesn't matter. When you sell a piece of stock, you have to report that sale, and you're going to report that sale, and there's going to be a gain or a loss based on your basis in the stock, what you paid for it. So how are your gains and losses from stock reported? When you invest in stock and you hold that stock for a year and a day, you have a long-term gain. What does a long-term gain mean to you? Well, it means less income taxes because your stock is going to be taxed at the capital gains rate, which is lower than the normal income tax rate. The normal income tax rate is what we call the short-term gain rate. That means it's just going to be your ordinary income tax rate, which is typically going to be a lot higher than your long-term capital gains rate. So remember, if you can hold your stock longer because you're a long-term stock investor, then you're going to be hit with capital gains versus ordinary income tax rates. Are you a day trader or are you an investor in stock? It's important that you identify where you are because this is going to determine the taxability of what it is that you are doing. If you are a day trader and you are selling for instant profit, that means that any net profit from the sale of your stock is going to be taxed as ordinary income tax rates. If you are an investor and you're holding on to your stock for the long-term appreciation, then you're subject to capital gains rates and short-term capital gains rate. Long-term, short-term. Day traders are business owners, and you come with a completely different tax code. If you are a long-term investor where you're investing in stock for future appreciation, then you are going to be looking at a completely different set of tax implications. What are the advantages of a day trader versus the advantages of a long-term investor? If you are a day trader and you are in a business, that means that you can write off all your other business expenses, making sure that you are reporting your day trading on the proper form, probably a Schedule C if you're operating as a sole proprietor versus on a Schedule D. Making sure you maximize your deductions because you are actually operating as a business owner. If you have net profit, just like any other business owner, your net profit is going to be subject to self-employment tax. On the other hand, if you are an investor in stock, you want to take advantage of tax loss harvesting as an investor in stock. What is tax loss harvesting? Tax loss harvesting is really where you sell your stock at the end of the year so that you can benefit from the losses that are on paper. That's what tax loss harvesting means. It is a game that the rich people play, but it's a legal game. On December 31st, they say to themselves, where am I with my stock? And if I have some losses, let me go ahead and sell off that stock so I can take advantage of those losses. But with every game, there are rules so that you don't end up with the foul. You want to make sure that if you do tax loss harvesting, that you watch out for wash sales rules. What does wash sales rules mean? That means that if you sold a stock on December 31st, I have to wait at least 31 days before I can repurchase that stock. Let me give you an example. Let's say that I have some Google stock that I sold on December 31st. I can't sell it on December 31st and turn right back around and buy it on January 1 and take the losses from the sale on December 31st. That's the wash sale rule. You will not get the benefit of the loss. So if you're going to do tax loss harvesting, you want to make sure that you play the timing game properly and give yourself the full 30 days before you repurchase the same stock. So now that you understand what it means to start diving into owning stock, we talked about long-term capital gains, we talked about short-term capital gains, we talked about being a day trader versus a stock investor that's looking for a long-term appreciation. We talked about tax loss harvesting. Make sure you understand these things so that you can really start to make money off of your stock investments. And at the end of the day, regardless of what all the gurus say to you, having money in the stock market is always going to be a good thing, because it's just not about timing of the market, it's also about your time in the market. And now that you got your timing right, it is time for you to like, comment, and subscribe so you don't miss out on any wealth building information.